The yield is probably seeing a floor around 4%. I'm talking about the 10-year yield. All right? So that would be keeping the market on edge. But the net effect of that downgrade, right, that we saw a couple of days ago, right, is not as dramatic as what people would have thought, right? Certainly not like August 2011 when everything was hitting at that time, right? That was the first time that the U.S. was downgraded from AAA. This is the second time. The impact is not so much, right? At that time, there was really a lack of growth, lack of inflation. Right now, we almost have too much of that. Very different environment. The most important item here is that most of the institutional investors, they're not benchmarked against AAA anymore. They're benchmarked specifically against U.S. Treasuries. So if you downgrade U.S. Treasuries rating, the risk-free rate is still U.S. Treasuries, right? Unlike before. So the net effect of that is actually not so big in terms of people forced to sell U.S. Treasuries. That's not the net effect.
So do we stay invested in this market then? Or when you look at the multiples, and when you look at the multiples especially for a name like Apple, for instance, and the reaction after hours post-earnings, is that telling you that there are problems on the horizon?
Well, in the very, very, very long term, right, the budget deficit in the U.S. is an issue. That's a very, very long term, right? Talking about like a 6 to 12-month horizon, right, in the near term. Basically, U.S. is looking expensive. And I've talked about the concept of the comfort zone in U.S. equities, right, back a couple of months ago, where people saw that, the FANGs, they're working, and therefore they are very comfortable adding more or holding on to them, right? So now all these little cracks, right, this Fitch downgrade and the possible slowdown in U.S. economic data, right, they could lead to some rotation, some trimming, right? Not selling out completely, but trimming of U.S. equity position and rotating it into other parts, other regions, right? So if you see that actually the Chinese equities, they actually could be the beneficiary from this, because you've seen that there has been some reasonable action in, say, the U.S. ADR and Hang Seng, right, over the last 3 weeks, some increase in volume and some upward price action. So that shows that there could be some funds rotating into Hong Kong China equities because the U.S. is looking toppish, and economic surprise could be may not be delivering as much economic surprise as they were before.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.